Microsoft, stock ticker MSFT, is trading close to its all-time high at $404 per share. The stock is up 9% year to date after rising 57% in 2023, which raises an important question. Did the stock price reach its tipping point, or is there still room for future growth? In this video, we will answer this question by analyzing the Microsoft stock, reviewing important financial metrics, comparing the stock's performance against competitors, and assessing the stock's dividend safety. By the end of the video, we will run the numbers through our valuation model, discussing potential risks and deciding on an acceptable buy price with a reasonable margin of safety. Before commencing our analysis, I first want to welcome you all to Investopia and just remind you that this is not financial or investment advice and that you should always do your own due diligence and make decisions based on your own circumstances. With that being said, let's get right into it. Founded in 1975, Microsoft is an American multinational technology corporation which develops, designs, and supports software, services, devices, and solutions worldwide. The company is best known for its Windows operating system and its Office productivity suite, which includes Microsoft Word, PowerPoint, and Excel. And just for context, in 2022, Microsoft announced that there were more than 1.4 billion active monthly devices running Windows 10 or Windows 11. And that's only in 2022, and only for those two versions. Since then, this number has only increased. Microsoft is currently the largest company in the world, surpassing Apple and the $3 trillion mark. Despite its size, it's still an extremely well-diversified company, which we can easily see from the latest fiscal year 2024 second quarter report. As you can see on the screen right now, server products and cloud services, which includes Microsoft Azure, the second largest cloud provider in the world, generated $24 billion, making up 39% of total revenues, which is the largest share. Office products, which includes the Office 365 suite, came second with a share of 22%. Revenues generated from gaming, Windows, and LinkedIn trailed with 11, 9, and 7% respectively, while search and other revenue-generating products made up the remaining 13%. At the time of filming this video, Microsoft trades at a price-to-earnings ratio of 36.5 and has a dividend yield of 0.74%. Looking at the stock's performance over the last 5 years versus the S&P 500, we can see that Microsoft significantly beat the S&P, increasing 264% since February 2019, while the S&P increased 79%. Now, when comparing its performance with its competitors, Apple, Google, Oracle, and Adobe, over the last 5 years, we'll notice that the entire industry has been booming, with all 4 companies outperforming the S&P 500. Apple was the only one that beat Microsoft with a 322% return, while Google, Oracle, and Adobe trailed, increasing 152%, 112%, and 111% respectively. Moving on to Microsoft's financial statements, we can see that revenues grew from $134.2 billion in 2019 to $227.6 billion in 2023. That's a CAGR, or a compound annual growth rate, of 13.6%. Similarly, we can see that net income increased from $44.3 billion in 2019 to $82.5 billion, which is a CAGR of 16.3%. You'll see that both metrics had consistent increases year to year, except in 2022, where net income decreased slightly before rebounding back in 2023. So overall, we see very strong top and bottom line growth, especially for such a huge company, with net income almost doubling in this 5-year period. As for the balance sheet, we see that the cash balance in 2019 was $134.3 billion and decreased to $80.9 billion in 2023, which is a CAGR of negative 11.5%. Current assets, which also includes the cash balance, decreased as well, from $167 billion to $147.4 billion. That's a CAGR of negative 3%. Net debt, which is a sum of short and long-term debt minus cash and cash equivalents, increased from negative $57.5 billion in 2019 to $7.4 billion in 2023, which is a CAGR of 16.3%. Now, you'll notice that here it says 0%, but that's because the normal CAGR function does not really handle negative values well. So you have to use absolute values. Anyways, there's no need to worry about that for now. Just know that net debt increased at a compound annual growth rate of 16.3%. So the balance sheet looks quite interesting. Cash and current assets are decreasing while net debt is increasing, which is the exact opposite of what we would like to see. However, it's important to understand why these trends are happening. Are they a result of underlying financial issues or potential positive shifts in the company's strategy? If we take a look at the cash flow statement, you'll notice that there are two main reasons behind this negative trend. First is the increased investment in property, plant, and equipment, also known as CapEx, which occurred in 2023, increasing from $24.8 billion to $35.2 billion, which is a significant increase if you compare it with previous years. The second and more impactful reason is acquisitions, which increased from $21 billion in 2022 to $66.9 billion. That's a huge increase of $45.9 billion in 1 year. Most of these acquisitions and capex expenditure are driven by Microsoft's investments in cloud and AI infrastructure as they aim to establish their dominance and win the AI battle against their competitors. So the only question is, will these investments actually prove successful in the long run? We'll have to wait and see. In terms of the dividend, Microsoft has a dividend safety score of 99 out of 100, which gives it a very safe rating and means that a dividend cut is very unlikely. It has been paying the dividend for the past 17 years without a reduction and has been increasing the dividend for the past 13 years. The dividend has been increasing on average 19% in the last 20 years and 10% in the last 5 years, with the latest increase coming at 10% in September 2023. As we can see here, Microsoft's dividend yield of 0.74% is lower than its 5-year average of 0.97%. which indicates possible overvaluation. Similarly, the forward PE ratio also indicates overvaluation, currently at 33.3 compared to its 5-year average of 30.1. However, as we always say, we do not look at any metrics in isolation and will only make conclusions by the end of the video. Both earnings and free cash flow payout ratio are consistently under our preferred 60% threshold. In 2023, the earnings payout ratio was at 28%, while the free cash flow payout ratio was at 34%, with both expected to drop in 2024, giving plenty of room for future dividend growth. Shares outstanding have decreased from 8.4 billion shares in 2014 to 7.5 billion shares today, meaning that Microsoft has been buying back its own shares. We generally like to see declining shares as it signifies that our ownership stake in the company is getting bigger and that the company's profits are being distributed on less and less shareholders. Now, coming to Microsoft's return on equity and return on invested capital, and just in case you don't remember or you're new to the channel, a high return on equity usually signifies a company's moat, while the return on invested capital reflects management's ability to effectively allocate and reinvest capital. Generally, we like to see a minimum of 10% for both metrics. However, as I always mention, the thresholds could change slightly depending on the industry. As you can see here, since 2014, both metrics have been consistently surpassing our 10% threshold, averaging 28.6% and 25.1% respectively. Now, remember the substantial amounts that we saw earlier, which Microsoft has been spending on capex and acquisitions recently? Well, return on invested capital is the metric we should use to evaluate those investments. And based on the values that we see here, Microsoft has been doing really well generating values from its investments in the past 10 years. Therefore, I would personally say that it's highly probable that these future investments will also yield positive outcomes. In terms of operating and free cash flow margins, we see a similar story, with both metrics comfortably beating our preferred thresholds. Since 2014, operating margin has consistently exceeded 30%. Averaging 35.1%, while free cash flow margin was generally in the high 20s, low 30s, averaging 30.6% in this 10-year period. As for net debt to EBITDA, net debt to capital, and interest coverage, there's nothing really to show here. As we observed in the balance sheet, despite the recent relative spike in net debt, Microsoft has virtually no debt due to the significant amount of cash it holds. Therefore, we can confidently say that Microsoft has a very strong balance sheet and a safe dividend. Now, as always, before moving on to our valuation models, let's first see how Microsoft performed in the last recession of 07-08, especially with the ongoing speculations that another recession could happen in the near future. As we can see here, Microsoft maintained the dividend during the recession, their sales decreased by 8.8%, which was the average during that time, and finally the stock declined by 48%, which beat the S&P 500, which declined by 55%. So overall, we see average performance from Microsoft during the last recession. Jumping into our valuation models, we'll be reviewing 4 distinct models to get our intrinsic value and acceptable buy price. If you're enjoying the content so far, please smash the like button and subscribe to the channel to ensure that you're notified once we release similar videos in the future. Now, I've received a few requests asking for a copy of these models, so I'm happy to announce that they're currently available. If you're interested, you'll find the link in the description below. Our first valuation model is the discounted free cash flow model, where we estimate Microsoft's intrinsic value based on the present value of their estimated future cash flows. We can see here the free cash flow that Microsoft generated over the last 10 years, growing at an average 10% per year. Based on analyst estimates, we use a 15% growth rate for future free cash flows. Personally, I find it hard to imagine a $3 trillion company continuing to grow at 15%. But if any company could achieve it, it would be Microsoft. I don't think it's a conservative estimate, as it pretty much assumes that Microsoft will continue to dominate the AI space alongside Nvidia, but that's just my opinion. Let's go with it for now and see what we get. Using an 8% discount rate, which is also our desired rate of return, we get the present value of all future free cash flow as well as our terminal value. Adding them together, plus cash and cash equivalents, minus total debt, we get our enterprise value, which is the estimated total value of the company. Dividing the enterprise value by the total shares outstanding, we get a fair value of $368 per share, which is lower than Microsoft's current price, indicating overvaluation. Again, if you'd like to make your own assumptions or use a higher discount rate, please feel free to get a copy of the valuation model from the link in the description below. The second method is the multiples valuation model, where we obtain Microsoft's fair value based on the multiples of its competitors and companies within the same industry. We do so by getting their current PE multiples, calculating the average PE, and multiplying it by Microsoft's current earnings per share to get our fair value, which is $372 per share. The third method is the dividend discount model, where we estimate Microsoft's fair value based on the present value of future dividend payments, specifically used for dividend-paying stocks. We can see here Microsoft's total dividend paid per share in the last 5 years, which grew on average 9.9% per year. Now, given Microsoft's dividend track record, it's possible that they continue to increase the dividend at this rate. However, I decided to be a little bit more conservative and go with a 7% growth rate for future dividends, especially considering the company's current expanded investments in CapEx and new acquisitions. Discounted at 8%, we get a fair value of $299 per share. The last method that we will review today is the historical multiples valuation model, where we estimate Microsoft's fair value by considering the normal PE ratios that the stock traded at historically. In our analysis, we'll use the 5, 10, and 20 years normal PEs. As we can see here, the Microsoft stock was trading at an average 32 PE during the last 5 years, 23.8 for the last 10 years, and 19.4 in the last 20 years. We calculate their average and multiply it by Microsoft's current earnings per share to get a fair value of $278 per share. Finally, to obtain our intrinsic value and acceptable buy price, we take the average of the 4 fair value estimates generated by our models. The intrinsic value we get is $329 per share, which is much lower than the stock's current price. In fact, our estimated intrinsic value is 19% lower than the current price. So without a margin of safety, you would need the stock to drop 19% for it to be a buy today. However, as we always say, you always want to have a margin of safety to protect against downside risk. For high-quality companies with a white moat, strong balance sheet, and good forward-looking data, a 10% margin of safety could be justified. With a 10% margin of safety, our acceptable buy price would be $296 per share, which is 27% lower than the current price. Now, you might be wondering, how does this make sense? How could Microsoft, one of the current leaders in the AI race, beating the likes of Google and Amazon, especially with their OpenAI and ChatGPT investment, be so overvalued? What about the future growth prospects? Well, the answer is pretty simple. As we discussed in our Nvidia stock analysis video, Benjamin Graham, who was Warren Buffett's professor and mentor, once said about the stock market, and I quote, "In the short run, the market is a voting machine, but in the long run, it is a weighing machine." Graham meant that in the short run, price fluctuations are driven by emotions and consumer sentiment, or popularity. However, in the long run, the fundamentals of the company is what actually determines the stock valuation, hence the weighing machine. So yes, Microsoft is surely benefiting from the AI boom, but are the company's fundamentals growing at the same rate as the stock price? Going back to our financial metrics, as we saw before, over the last 5 years, revenues increased from $134.3 billion to $227.6 billion, which is a 69.5% increase, while net income increased from $44.3 billion to $82.5 billion, which is an increase of 86.2%. At the same time, the stock increased 264%. So you can clearly see that despite the increases in revenue and income, the growth is nowhere near the growth of the Microsoft stock price, which demonstrates Microsoft's biggest current risk. overvaluation. Honestly, other than this major risk of overvaluation, and unlike Nvidia, I personally don't see any other significant risks for Microsoft. The company has virtually no debt, is extremely well diversified, and is a global leader in multiple revenue generating streams. You could maybe argue that there are risks from competition, such as Google Cloud potentially taking over some share from Microsoft Azure, but overall I think Microsoft's strong financial position and diversified business model considerably mitigates these concerns. With that being said, if you still want to consider a high margin of safety, say 15%, the acceptable buy price would be $280 per share. If you're looking for a 20% margin of safety, your buy price would be $263 per share, which is over 35% lower than the current stock price. In terms of Wall Street's expectations for Microsoft stock, they're forecasting it to trade at $439 per share in 12 months, which is much higher than our estimated intrinsic value, but only $35 higher than the current price, implying a 9% potential upside from current levels. Now, I personally like a 10% margin of safety for Microsoft. I do believe the company has a wide moat, a strong balance sheet, and great forward-looking data. Alongside Johnson & Johnson, Microsoft is one of 2 companies in the entire world with a AAA credit rating, which is even higher than the US government. I currently do not own a position in the company, but I do have it on my watch list. However, if I did own it, I would not sell, despite the overvaluation. I might consider trimming a little bit of my position, but only if I find another opportunity with a better risk-reward ratio. As a long-term investor, I prioritize buying at reasonable valuations and holding for extended periods of time, and I always try to do my best to not get affected by short-term market fluctuations. So at this time, I will just wait patiently until the price drops to more reasonable levels. If you enjoyed this analysis, make sure to check our other stock analysis videos and let me know in the comments below your thoughts about the stock and whether you're making any moves with Microsoft in your own portfolios. With that being said, don't forget to like and subscribe, and I'll see you in the next video.